I'm very excited for today's video. I have one of my good friends and colleagues, a very wise man named Dustin Lester, and a lot of content that's missing on YouTube is talking about variable life. Today, Dustin's gonna break down variable life and where you need to learn about it so you can use it as well. I get to sit down with my good friend Dustin Lester, brilliant advisor, and today we're going to talk about a topic that's really fun for me because I never talk about VUL on my channel. It is out there. You don't see a lot of content on it. A lot of people that are big life insurance content creators focus on term, whole life, index universal life, UL, but nobody's really covering VUL very much. And I think that's because, I don't have a license to offer VUL, so I don't get into that. A lot of people online that aren't licensed to do VUL, you do need a special type of license to even offer it. So I wanted to just take time with Dustin because he's somebody who I view as an expert in this space. He's been an advisor and in the insurance industry for how long, Dustin?
In 2003, I got my license in February of 2003.
So 21 years.
21 year, yeah.
Yeah, dude, in your 21st, yeah, incredible. So let's dive into VUL. Let's just start with what is VUL, because whenever somebody's like going like, oh, I understand whole life, I know index, and then they go, what's VUL? What is that? How would you describe variable universal life?
It is an annual renewable term with an investment that is considered what's called a sub account attached. So think of it, a sub account is very similar to a mutual fund. It's just under a different tax code. It's typically run by the same mutual fund managers and everything. So, whatever your favorite mutual fund company is, they most likely have a sub account division for the variable space. But basically, you take annual renewable term insurance, you calculate it every year, and then you add to it fees and expenses. Again, this is not a free product. Those fees and expenses, you want to evaluate very closely, just like any investment. The lower the fee, the better for the client. Mm-hmm. The lower the commission, the better for the client. All of those things matter. And so again, you're getting into this commission structure world where you're selling a product that has a different type of structure in terms of how we're compensated. And so when we have something called a fiduciary standard, and in the fiduciary standard, we have to, disclose things that are what we call conflicts of interest. And so, but long story short, in a variable life sale, what you really want are three things, in my opinion. You want a client that finishes what they start. Okay. You want a client that has a need for the insurance first. Okay. If you don't have a need for the insurance, it makes this a much harder conversation to justify in some ways. And then last and not least, you need somebody who has a little bit higher, what I call complexity threshold. I know that sounds strange, but I meet business owners that might make $2 million a year. And if I go to them with something complicated, they look at me and they go, shut up, get out. If I can't understand it in 5 minutes, I don't want it. No problem. You make $2 million a year, sir. You're smart as hell. You run this company. I get it. And then I meet people who have almost no money, but they're an engineer and they want to know everything. And they want to they're in it, and so again, this is the type of person, not an economic strata, but ultimately somebody who's okay with a little bit higher level of complexity, because this doesn't work the same as a regular investment account. And so typically what you're doing in a variable universal life sale is you're identifying a need for insurance as well as a savings and investment plan. And so the way that it's different is you invest the money in the contract, and it's divided into two pots. One pot is for cost of insurance, fees, and commissions. The other pot is going directly into whatever investment you want. So if you want just an S&P 500 account, you can have that. If you want, in most contracts, I don't know what contract you're looking at, but again, you would want to work with an advisor to help you evaluate that. And basically, you got to look at the fees, expenses, just like you would any other fund, and pick the one that you want, or pick the portfolio that you want. And your advisor should help you do that and manage that. The benefits of the variable life contract, if they're utilized correctly, is you can use that index fund and you can compound your wealth inside of it without paying income tax, dividend tax, interest, capital gains. You can rebalance and there's no expense. There's no trading fees.
Wow.
You can go to cash. You can go back into your investments. But those are taxable events in a normal brokerage account, right? Unless it's in an IRA or something. But you're not going to do an IRA in this. This is going to be all non-IRA money. And so ultimately, what you're looking for is a long-term approach to building wealth that you can get a tax benefit on long-term. And the way the life insurance works for the client on the back end, if they're using it for a living benefit. So that's the way I want to basically, let me go back and kind of say that. There's two parts of this contract. There's a living benefit and a death benefit. The death benefit is for your family or for your charity, maybe your church, right? Whatever it is you want to leave it to. The living benefit is if you want to borrow against that death benefit before you pass away. And so you're allowed to do that. So the way you build your contract depends on how this is worded and everything. But basically, if you go in and you've got $1 million worth of cash value in here and it makes a 5% return net of fees and expenses, that's $50,000 of return inside of your investment. If you choose to sell it, you can borrow it from yourself. And depending on the contract, there's provisions on borrowing. It could cost you money. It could be a net cost of zero, but again, depends on the contract. But you borrow from yourself. And because it's a loan against your death benefit, there's no income tax on that distribution to you. There's no dividends to you. There's none of that. And so if you follow the rules, right? The only way it stays tax-free is if you pass away with the contract. So if you remember, the first thing I said is you want a client that finishes what they start. If they're going to buy a permanent life insurance policy and then get rid of it 7 years later, I'm like, what? Yeah, it's like, I'm going to go, you can't do stuff, but they're not aligned. You didn't do a good job as an advisor aligning that person with the right structure because they can't finish it. And so anyways, long story short, it's a great hybrid type of product. If you have somebody who has a death benefit need, they make maybe too much money to do other investments that are tax advantage, like a Roth IRA. And those are who we target for that kind of sale typically. The vast majority of our clients, and I think you'd agree, term is fine for the death benefit part. But when you go deeper into the planning, sometimes you can find the necessary and good need to create a bucket of money that isn't just for when you're 60, right? I mean, that's the crappy part about all the tax advantage accounts. You got to wait till the end of your life. Yeah. So not everybody wants to do that. And that's where I think we've found the most trends with the variable life sales. And so we typically are targeting executives at corporations or corporations themselves to put in place like deferred comp. We use those types of structures. And so it's an interesting product, but it's not for everybody. And it should be done very, very carefully if it's part of your plan. And your plan should definitely have an economic benefit once you do it. If you do your plan without it and you plan with it and there's no economic benefit, then you don't do it. And that's how, we work.
So Dustin, let me ask you a question. You see a lot of people online that buy whole life for this whole element of being able to borrow against the policy. You see people buying index universal life for the same thing, but with upside potential. Why variable life? What is why would people even look at variable life? What's the difference for people
The difference is variable life grows more. I mean, I'm not trying to be I don't give a crap about, and it's not all the time, and it's definitely not when in down markets. But the only thing that really stays ahead of inflation over time, and a long enough arc, has been the stock market. And that's not, it's not, again, like right now, we have massively high inflation. We could have a negative year. And again, the stock market didn't outpace inflation. But what I'm talking about is if I meet a young person like yourself, Danny, and you came to me and you said your income and it was high and you needed places to put money and you weren't investing back in your business and all this other stuff. And I say, hey, look, this is an option for you. And it's got liquidity and you can use it. You might say, man, I really like this. But the real reason that you're doing it as a young professional is because it's much better for you to put your money in something that's going to compound 5 times than something that'll compound twice.
Makes sense.
I mean, again,
Yeah.
so the best reason, or the reason why people would want variable is because they don't want a bond.
Yeah.
All the other types of investments in insurance are in fixed investments, like interest rate and sensitive products. And with the amount of debt the United States and the world has, it's going to be very difficult for them to keep the price of debt high and have interest rates be high. And so again, when I talk to somebody who's trying to build wealth, do they want to be stuck in fixed income bonds like a 78-year-old retiree?
Mhm.
Or do they want to be in and investing and capturing, what's happening in AI and what's happening in electric vehicles and cybersecurity and all these other areas that are like, that have nothing to do with bonds. Bonds will never, ever, ever go up 300%. It's just not going to happen. And so the reason you would do it is because you want to be rich and compounding your money smarter than not.
That makes perfect sense. I get that. So it's for the right type of person, and it's got different advantages that other types don't have, and different risks, which
And they have different advantages too, but that's not the conversation. The conversation is if you're greedy and you want tax benefits on a lot of money without any limit. I mean, I've seen a guy putting over $1 million a month in one of these.
it's crazy. So
Why? Because he doesn't ever want to pay taxes again. He'd rather
I have
pay it
two
once.
I have two follow-up questions, okay?
Sure.
You hear all the time about the wealthy people will buy, borrow, and die.
Mhm.
Does this fall into that type of framework, or
Kind of. Yeah. I mean, you're not. Um, it's already has tax advantages. It's basically, if you compared the cost of asset management fees and taxes to the
yeah.
cost of the underlying insurance costs,
Mhm.
commissions, and everything else, and you compared them side by side, that
Mhm.
should be your analysis. And so if your contract isn't less costly than taxes and asset management fees, don't do that contract. There are plenty of contracts that I've seen that are. And so, I'm not sure if I'm even answering your question again. What was the question? I'm sorry.
Like you hear the
Why?
phrase buy, borrow, and die, right? That's what the
Yeah,
wealth,
the by Barna.
and this is in relation to how they avoid taxation, right? How wealthy is more
Right.
tax efficient, or they do things from a tax perspective. You know, Unpack that buy, borrow, and die, and is
Sure. Yeah. Okay. So I had a client. He sold his trucking company. It was
yeah.
a $6.2 million sale. The total tax. He did it as an asset sale. Asset sale means that you're not selling your corporation. You're selling the assets of your corporation, and so because of that, it's all considered income for this person in 1 year.
Mhm.
That's a very large tax bill, depending on your state, especially. Right.
Oh, yeah.
It's an unbelievable. So ultimately, when we sat down to do the planning with him, he was like, "Oh, I'm going to net this much after tax," and we said, "What do you mean?" And he goes, "Oh, I'm getting this money, but I'm going to net this. I got to pay this. Is what my accountant is saying is due." Now, this was before interest rates were at 6.5, 7% for this kind of thing. But ultimately, at the time, this was right after COVID. I just was like, why pay the tax? And he was like, what do you mean? And I said, I go, let me show you what a lot of people do. They invest, borrow, and die. And I said, well, I could get you a line of credit from Goldman Sachs on this for 1.5% right now, because this is when interest rates were at zero.
Yeah.
And I said, why don't you just borrow the money and pay the tax? You can pay it off at any time. You have the money. So if it gets expensive, sure, pay it off. But nobody cares, right? Or just carry the interest and then invest all $6 million for your investments for your retirement. And so in that situation, that was just one exit plan. But let's say you were an executive at, I don't know, we'll use Tesla since we've talked to them about it, and you leave Tesla and you have to exercise $7 million worth of stock options.
Mm-hmm.
Again, how are you going to do it? Well, what a lot of people do is they keep the $7 million worth of Tesla stock because they think it's going to go up, and they just open the line of credit against it from a bank. And then the bank will lend them. There's requirements. Typically, it's maxed out at a 65% loan to value. It's risky because you're using leverage.
Mm-hmm.
Again, very, very specific type of client, has to have the money for it. And whatever money you do invest that is owed in taxes, my recommendation is you find something that has less risk than the market, but again, more return than the cost of the leverage. And that way, if you ever do need to pay it off, the money's there and you haven't lost it because the market dropped 50%.
Yeah. Let me ask you this question. That's a good point. I want to finish with this last question. So you see a lot of different pundits out there saying that nobody should ever use cash value life insurance in any capacity. What is your thoughts on, like you mentioned, you saw somebody who's putting $1 million a month into one of these VULs. Why do wealthy people buy life insurance?
Because it perpetuates their wealth. They're going to lose it anyway to taxes. The stakes are different. I mean, that's the easiest way of saying it. There's tons of wealthy people that don't. They just say to their kids, sell shit, and that's the most expensive. The real answer is it's less expensive than taxes. That's it. And they'd rather their kids get, in a VUL scenario, you're paying for commission to a guy like you or me, right? I mean, not you. I know you have the thing,
not me, but you.
It isn't fee-based. You're not allowed to have a fee-based one for some reason. But
okay,
I don't make the rules.
Yeah.
You're paying a commission to somebody once, though. You're not paying them for 30 years to manage this because, again, you're buying like an index fund. Who cares? Like, there's nothing to manage.
Yeah.
They get paid once, but then they have to service that for you, and they have to manage it with you for the rest of your relationship. Mm-hmm. The answer is I think people who are starting out and building, they should not do it. I think they should buy regular investments with no burdens. And like if I work with a client whose kids are under 30, I don't charge them really. I put them in brokerage accounts. Our trading fee is like $7 or something. And I don't even charge them because of how compounding money works.
Yeah.
You actually probably make more money not charging a young client who's 22 until they're 30 and then charging them from then on because of the amount of compounding they'll get. And they really don't need much at that stage. What they need is structure, and they need discipline to pay themselves first. They don't need an asset manager. They don't need comprehensive financial planning. They haven't even met their spouse yet, or they had their kids. Like, none of that matters. So again, it's what your situation is. But if you were making, you and I talk about the Jim Harbaugh thing all the time, but we have to do a video about that guy. But why did he do it? Because he made millions of dollars and it was awesome. And so like, it's when people have absolutes, I know they're not serious. I call those people financial pornographers. Okay. If somebody says all annuities are bad, they're stupid, because annuities have been around longer than mutual funds and stocks. Okay. You have no idea what you're talking about. And you should just be completely like embarrassed. Okay. If you say products don't exist that people don't want. And if they do exist, they don't exist for long. So it's just a stupid assumption. And it's people who are trying to sell one thing. If I'm only an AUM guy, let's make it about planes. If I fly fighter jets, do I think helicopter pilots are cool? Probably not.
Yeah.
Right. Then you slow those guys are. They don't have. I could destroy helicopter. Okay. Well, do you think helicopter guys who can like do all of the special ops and can go in and save people, do you think they think the jet guys are cool? No, they fight all the time in the bar. Well, neither of them are right. We need both. Why do we have both? Like, it's just a stupid conversation between people with egos. And so the answer is, it depends for each client. There is no outcome that is predetermined by the world, and especially by some guy on YouTube.
Yeah.
And so if you're not using a process-driven approach, then you're going to get that crap. If you're using processes, then you're going to get exactly what the process tells you to do. And you don't care. You don't have to worry about whether it's popular, and so ultimately, that's my best answer is don't be a financial pornographer. If it exists and it has for 100 years and you don't understand it, that's because you're ignorant. And I'm not saying that you can't be, you don't understand it.
Yeah.
And that's okay. There's a lot of things I don't understand that have been around for 1,000 years. Like, I don't understand the conflict in the Middle East. I'm not even going to try.
Yeah.
Okay. I'm certainly not going to say everyone's right on one side. That's dumb.
Yeah.
And so it's the same conversation when it comes down to those kinds of things. It's like, if you're that militant about it, I know you have an agenda. That's all.
Wow.
And it's like, use a process and prove it to me, and now we'll have the conversation like professionals. Other than that, it's like,
so much wisdom in that. I love it. That's so well said, and such a great framework for people to think within about where they're getting their information and education. That's awesome. And I want you to get credit for coining the phrase financial pornographer.
It's true. Like, I mean, how many rules we have? I think about how many rules we have and what we're not allowed to do and what we're allowed to do. And then I turn on CNBC and I get to see these people who are like short sellers. And it's unbelievable what they're allowed to do, So those guys, they're all financial pornographers. They're all trying to get something. They're trying to make money off you. That's okay. We're trying to educate. We're trying to do the same thing, but I don't want to do it based on all those people are evil or all of the. It's just dumb. It's just a complete waste of time because it's not intellectually honest or thorough.
Well, I appreciate that. I think everybody appreciates getting a little VUL 101 and some insights around it. If you want more information about anything we talked about in this video, VUL, they'll put Dustin's link down in the description. Please feel free to reach out. Dustin, thanks so much for joining, man. I appreciate it.
Hey, my pleasure. Thanks.
Thanks so much for watching this video. If you want more content from Dustin, check out this video right here. We talk about the 3 things that hold people back when they're looking at their investments.